Now we're going to apply the model of what we just did to individual stock valuation. So this is going directly to the stock price. P0 with a hat. Hat means expected. So this is the price of the stock at time zero with a hat on it. So instead of figuring out the value of the firm and subtracting the debt and dividing by the shares and getting down to the stock price, we're going directly to the stock price here. But the method is exactly the same. So just like before we had free cash flows and WACC, now we have dividends and the cost of equity. Okay, so it's exactly the same. The price of the stock at time zero is equal to dividend 1 divided by RS minus G, and dividend 1 is equal to D0 times 1 plus G. Okay, exactly like we did with free cash flows. Now here is a model that we have not covered. It's called the capital asset pricing model, the CAPM. So the CAPM is a model that helps us estimate the required rate of return on a share of stock. So RS stands for the return on stock, and RS is equal to the risk-free rate. So this is generally proxied by like a 10-year treasury bond. So the risk-free rate, how much do investors demand to be in risk-free assets, plus beta, which is a measure of risk, it's called systematic risk of the firm, times the market risk premium. So the beta of the market is 1. So a beta of 1.2 is 20% more risky than the market. The market risk premium is how much over 7 do investors demand to be in the stock market. So this is saying right now investors demand a premium of 5% to be in stocks rather than treasury bonds. Okay, so risk-free rate plus beta times the market risk premium gives you the required rate of return on equity. So that's our discount for stocks because stocks are equity. So we've got D0 is $2 and it's going to be growing at 6% and RS is 13%. So just like we did with free cash flows, so 212 is D1 divided by RS minus G, so the stock price is $30.29 if you have a constant growth rate. Okay, so this is the constant growth model for stocks. So the expected stock price in year 1 is going to be equal to D2, right, divided by RS minus G. So D2 is going to be 212 times 1.06 or that, and so this is the stock price in time 1. This says, okay, this is for P0 and time 1, but this is actually P1 and P1 and D2. Okay, so again, you can do it in any year. The stock price at any time t is equal to the dividend at time t plus 1, discounted at the cost of equity minus G. So we can break the return on a share of stock into the dividend yield and the capital gain. So if the stock is selling for $30.29 at time zero and the dividend was $2.12, then that's a dividend yield of 7%. Okay, and so the capital gain is what happens to the price. The price is going to go from $30.29 to $32.10, and so that's the gain divided by the original price gives us a capital gain of 6. So your 13% return is made up of 7% dividend yield and 6% capital gain. That's what this says. Okay, so the total return is equal to the dividend yield plus the capital gain, and the total return of 13% is the required rate of return for a stock of this risk as represented by a beta of 1.2. Okay, so we can rearrange this constant growth model to solve for R instead of P. And so this says what we just said. The expected return on a share of stock is equal to the dividend yield, D1 over P0, plus G, which is the capital gain. Okay, so same model, you use it sometimes to solve for P and sometimes to solve for R. Now, this P has a hat on it, and so that's an expected stock price, okay, and this R has a hat on it. This is an expected return. Conceptually, the expected return on the stock using this model is a different number than the RS that we got from the CAPM. The CAPM is the required rate of return based on risk. This is the expected rate of return based on the cash flows. conceptually, those are two different numbers, but in equilibrium, they need to be the same, right? Because if the expected return was greater than the required return, everybody would flock to buy this stock and drive the price up. And they would drive the price up until the expected return and the required are equal. So sometimes we use the models interchangeably, but it's important to know that they are different models. So just like we did with free cash flows, we're going to do non-constant growth. So let's say that the dividend is going to grow 30% from 0 to 1, 25% in year 2, 15% in year 3, and then a constant growth rate of 6% thereafter. Okay, so just like before, we can't use the simple model because we've got non-constant cash flows. And so just like before, we're going to forecast the dividends out one at a time and then get the horizon value at the end of the period of supernormal growth, we call it. Okay, so this looks just like what we did before, right? So you've got D1, D2, D3, and then we've got P3. This is the price of the stock at time 3, which is equal to D4 over RS minus G. And then again, using Excel, we find the present value of the cash flows is 46.66. Okay. And so again, like we did before, so the dividend yield is 260 over 46.66 or 5.6, and the capital gain is 7.4. So during non-constant growth, the dividend and the capital gains yields are not constant percentages. Okay. It's if the current growth is greater than the long-term growth, then the capital gains yield is going to be bigger than G. So after times 3, it's going to settle down to 6% capital gains, 7% dividend yield, and it's going to stay there forever. But until we get to time 3, they're going to vary. So we don't spend a lot of time on PE multiples in finance class, but they are used a lot in practice. And so analysts often use PE multiples to figure out what the stock price should be. Again, this is for a company that's not publicly traded, because if it's publicly traded, we can see what the stock price is. So the way we use PE ratios is we try and find a group of comparable companies, companies that are in the same line of business that we are, and they're publicly traded. And so we look and see multiples of all kinds of things. So we can use EBITDA, earnings before interest and taxes, depreciation, amortization, sales, customers, eyeballs, whatever you want to measure. We can pick a measure, and then we can see what the entity value is. So that's the market value of the equity. And divide it by these things and calculate a multiple, and then apply that multiple to our EBITDA, sales, customers, eyeballs to come up with a valuation for our company. Okay, so you come up with the firm's total value this way and then subtract the debt to get to the value of the equity, just like we did in the free cash flow method. So this is a good check. So sometimes when I'm doing valuations, I'll do a free cash flow valuation, and then if I can find the multiples, I'll do it to see, are these in the same ballpark? Because if they're not, then I'm probably going to have to adjust my assumptions in my free cash flow valuation model, provided I have good multiple or good comparables. And so the problems with the market multiple method is it's often hard to find comparable firms. So even if they're in the same industry, they may be different than us on some dimensions. And also the average ratio for a sample of firms varies widely. And so who do we compare ourselves to? The low performers, the high performers, some average number. So comparing the free cash flow model and the dividend growth model. The free cash flow model is more general, and it's how we can use value-based management. The dividend growth model is a simple little model for figuring out stock prices, but the free cash flow model is a perfectly general model that can be used for any company, any business, privately held divisions. This is also where it's cool, is in divisions of companies, and you don't obviously need to pay a dividend for the free cash flow model. So it is the more general of the two models, and it's the one that is going to give you more value for your buck, I think. And it's the model that you're going to be using for your projects to figure out how to increase value in your company by doing something different. You're going to forecast your free cash flows and figure out what your value is. Really quickly, preferred stock, hybrid security, it's similar to bonds in that The preferred stock dividends are fixed, like interest is fixed on bonds, but preferred stock dividends are not tax deductible to a company, but they must be paid before common stock dividends have been paid. But they can be omitted without putting the firm into bankruptcy, like omitting interest on a bond would be. Preferred stock dividends don't grow. They're typically a number and they sit there. And so this is the same model as the constant growth model. It's just that G is 0. So this is dividend times 1 plus 0 divided by RPS minus 0. So it's the same model, its growth is just 0. So for preferred stock, we just have the dividend over the required rate of return on the preferred, and that gives us the value of the preferred.